Morning, everyone, and welcome to the last Kepler Trust Intelligence Alternatives for Income Investors event for the week. Uh, Today, we're joined by Philip Waller, who's a portfolio manager at JPMorgan Global Core Real Assets. JARA is an alternatives investment trust and invests in infrastructure, transportation, real estate, and listed real assets. Before I hand over to Philip, just a reminder that you can ask questions throughout. So um, if you have any, just put them into the Q&A function that should be on the right-hand side of your screen. And once Philip has finished presenting, then we should have time to answer. He should have time to answer some of your questions. So, Philip, thanks very much for joining us, and I'll hand over to you.
Brilliant. Thank you, David, and obviously thank you everyone who's joined this morning. Yeah, obviously delighted to be here to give everyone an update or maybe an introduction for those who haven't heard the story before to the JPMorgan Jara, because it is somewhat of a mouthful. So yeah, first maybe just starting off on what in essence we are trying to achieve with Jara, and really what we've looked to build here is a cornerstone allocation for people within the real asset market or within the kind of diversified bucket a lot of investors have nowadays. I think we get that cornerstone quality in a couple of ways. So I think first and foremost, what we're looking to do is very much global in nature. So we're not focused on any one country. We're not a UK-centric vehicle. And in many ways, we're actually quite a nice global complement to the often UK-centric asset portfolios a lot of investors have. We're also not, again, focused on any one particular sector within the real asset market. We are called the three big food groups within real assets, which are infrastructure, real estate, and transportation. And really, it's that diversification that gives us the ability to actively manage over time the exposure that we have to obviously try and optimize the best returns, and also, importantly, make sure that we're diversified in such a way that we try and get a resilient return for investors, and also one that has obviously a resilient income profile as well. We build Jara, or we have built Jara, utilizing the JPMorgan Alternatives platform. That is a 200 billion plus alternatives platform diversified across various different parts of the private market. And roughly half of that 200 billion is real assets. So it really is the bread and butter of what we do. However, the significant majority of the assets that we had on that platform was primarily institutional in nature, pension funds, insurance companies. And what we look to do with Jara is take the existing private strategies, private vehicles that we have that have often been built out over a number of years, in some cases decades, and offer them into the private market via the investment trust. The real benefit of that is, I think, with Jara, we have access to an immensely diversified portfolio of assets, over 1,000 private assets within Jara on a look-through basis, meaning that we're able to remove a lot of the idiosyncratic asset risk that often comes with smaller, more concentrated portfolios. And also, I think importantly, we're able to invest in, I think, quite different assets to what you're scaled. Often we're owning real estate assets or transportation assets or infrastructure assets that are very, very different, either through size or the long-term nature of them compared to what you often see. And so again, a nice complement to what is already out there. You can just see on the left-hand side of this slide, just in terms of what we're looking to achieve. So 79% net total return, of which roughly 4 to 6% of that comes from income. So, we typically think about the return profile as hopefully being around 2/3 driven by income. And I'll talk about in particular the part of the real asset market, the core real asset market, which we focus on, which hopefully gives us that predictable income stream. JAR has been going since late 2019. So, you know, in terms of an IPO date, one which will be launching effectively a couple of months before the pandemic hit. And it's, so, you know, it's been let's call it a baptism of fire, but in many ways, one which, you know, really now we've been invested for, or fully invested for kind of 12 to 18 months, one which we've shown that we can come through in a resilient way and really show, I think, what JAR is worth. You can just see here on the page our 1 year returns. So we've kind of been going 2.5 years. The first year or so of that was a ramp up period where we were getting the money in the ground, and it did take us the full year to get invested, really driven by the fact that the pandemic obviously made making investments something we need to take, you know, a good amount of time on. But now we're fully invested, you can start to see the returns come through. So 12.7% return over 1 year, and that kind of 4.4% income number being within our 4 to 6% target range. To, I suppose, show what we're trying to achieve with JAR and really offer to people in their portfolios. Here what we have is some analysis using JPMorgan's long-term capital market assumptions. This is a piece of work we do every year, which effectively looks to underwrite the expected returns we have from pretty much every asset class we invest across both public and private markets over a 15-year basis. So really looking at what returns do we expect for different asset classes across a couple of market cycles. And you can just see here the purple line being the you know, stock bond frontier. And you can just see above that the kind of squared or the kind of highlighted JARA box, which is where kind of JARA's portfolio based on the long-term capital market is that we're allocating to primarily private markets, assets that are, you know, commanding an illiquidity premium, assets that are by their nature income orientated and often relatively low volatility. We sit nicely above that stock bond frontier, earning a healthy return for what is actually, I think, quite an attractive level of volatility. The blue line shows what adding JARA to a 60/40 portfolio does, so improves portfolio efficiency in a way which is obviously quite attractive. But also what's worth highlighting here is JARA's relative position to single real asset categories. And as I said, we are a diversified core real asset strategy, so investing across various different parts of the real asset market. And really, the benefit of this is by themselves are good diversifiers against, you know, stocks and bonds, but importantly, they're good diversifiers against each other. And so, you know, the correlation between what goes on in a European wind farm versus a US logistics hub is quite low. And so actually having these different parts of the real asset market within one portfolio in a cohesive and thoughtful way should actually offer almost a double layer of diversification, which is why actually, whilst our total return is relatively similar to other parts of the real asset market, we do sit on the left from a volatility perspective, because combining the different parts of the real asset market can kind of offer some efficiency in terms of having an uncorrelated return profile, both on a total return basis, but also importantly, I think, from an income basis as well. So I mean, they're kind of a lot of market assumptions, but also thinking about where we are in the current market cycle. And obviously, you know, as is talked about very, very often, we're in a market where we have rising interest rates, rising inflation rates, and we've just done some analysis here to show again what or how has JARA's portfolio. So this is a back-tested view over the last 20 or so years. How has this portfolio performed when you've seen similar market environments? And so what we've done here is, again, taken JARA's model portfolio, looked at all the cases in the last 20 or so years where you've had either rising interest rates, falling interest rates, rising inflation rates, and falling inflation rates, and looked at how the portfolio has performed. And obviously, we're on the left-hand side at the moment. We're in a rising interest rate, rising inflation. Interesting, but really, what I wanted to point out is the relative performance. So looking at the left-hand side versus the right-hand side in terms of how has this portfolio performed. And I think importantly, given what real assets offer, that is typically a return that has some correlation over time to inflation. Actually, this is not a negative scenario for these assets. Actually, this is typically a market environment where you've seen slightly better performance than you have in other environments. So, for example, looking at a market where you've seen rising inflation rates on the bottom left, that is significantly better or notably better than in markets where we've had falling inflation rates. And that's because the assets that we're targeting, the core assets within the real asset market, are income or have some correlation over time to inflation rates. Importantly, and I'd highlight this as a kind of a point to note, really to benefit from higher inflation, it has to be sustained. And that's what we would expect for JARA to perform well in terms of a slightly sustained inflationary environment, not one that necessarily spikes and comes back down. And so often we'll expect this benefit to feed in over time, not necessarily to feed in straight away. So a little bit more now. So we've talked about kind of, I suppose, the case for JARA. Now let's talk about what we're doing. And JARA stands for JPMorgan Global Core Real Assets. I just wanted to spend a quick minute on what we meant by core, because firstly, different managers, different investors define that slightly differently. But also, particularly coming to here to kind of is really important in terms of where we're getting the return from, which is income, and also what type of income we expect to get. So I think, like any market, the real asset market has a spectrum. At one end, you've got what we would call core, which is the higher quality part of the market. And at the other end, you've got more opportunistic real assets. Maybe to give an example there, at one end, you would expect developed, stabilized infrastructure that's maybe earning the return from a contracted profile. And at the other end, you may have development real estate where you bought land and you're looking to build on it. There's no right way and there's no wrong way to do real assets, but clearly you've got one which is, I'd say, more predictable and more stable in nature, and one which is we're very much at that core end. So what we're looking to do is invest in real assets across developed markets that are really generating 2/3 plus of their return profile from income. However, importantly, as we kind of highlight in these different boxes on this page, a high level of income isn't enough for us. Importantly, that income also needs to be highly forecastable, highly predictable, and have a low margin for error. So in effect, what we're looking to do is invest in real assets that effectively provide the significant majority of the return from either a contracted or regulated income stream. That is, I think, where a lot of investors want us to be, because when they're allocating to the real asset market, they're either doing it or they're looking for a diversified return. And obviously that income, often coming from contracts that are uncorrelated in nature in terms of what is driving the return, give you that diversification over time. And so importantly, focused on that high quality of the spectrum, which means you get that kind of roughly 2/3 or so return from income. And obviously we're looking for that income to be predictable in nature with long-term contracts. And often, as I highlighted earlier, then contracts are what provide some of the inflation protection qualities people are looking for at the moment. We're also a solution, right? And I mentioned earlier, we're diversified across real estate, infrastructure, and transportation. And why is that important? I think it's important because real asset markets are not homogenous. They are incredibly different. Different in terms of obviously the assets themselves, the counterparties, and actually what you see is across the real asset market, quite a significant dispersion in terms of returns, depending on which asset class you're looking at. And so actually the case for a solution that is actively managed across different categories is quite notable. And actually you saw that play out in 2021. On the left-hand side, you can just see here the difference in return between JARA's top performing category, US real estate, and JARA's bottom performing category, which was infrastructure. Now, it's not to say infrastructure had a bad return at all in 2021, but it's saying actually with the US economy reopening, with the fact that the US consumer had cash in their pockets, both from spent up, from savings, but also from the government, actually, it's better on record. And so actually the ability to invest and actually overweight US real estate last year was really, really positive for a portfolio. And it's actually an opportunity we took advantage of. We could see, we had a view that that was going to occur. Kind of coming out of the first quarter of last year, you were still seeing relatively moderate returns from US real estate, but you could see how the economy was opening up. We therefore looked to overweight it with some of the spare capital we had. But also, as that outperformance came through, we were very, very happy to let that over allocation run. And so actually look to almost double down or really kind of maximize the benefit of that outperformance. And so we have been overweight real estate, in particular US real estate, over the last, let's say, 6 to 9 months, and benefiting from that return dispersion you see there. But what I just referred to there, which is trying to maximize returns, but also maximize stability of returns by thinking about what happens, what different returns you can see across different asset classes. But also we've got what is happening within each asset class. And with that, you've got my team that's looking for to do the asset allocation. But we also have dedicated teams at JPMorgan that are purely focused on their particular markets. And, for example, it will be the real estate teams or the infrastructure teams that are looking at each asset class and all the sectors across them asset classes and thinking about how do I maximize return within my part of the market as well. And again, there's a lot of value to be had there because, again, you see pretty significant return dispersions across a lot of the sectors, particularly at the moment. Over the last couple of years, dispersion across the top performing, i.e. industrial and logistics, and the lowest performing category within real estate, i.e. retail, is at an all-time high. Like many managers, we've looked to take advantage of that. We've increased our industrial allocation significantly. It's now the largest allocation within JARA. Really looking to take advantage of that dispersion. But it's not just real estate. If you'd have looked at the difference in return in transportation between aviation and container ships last year, you saw a similar dispersion. And so within JARA, you're really benefiting from an asset allocation view over time, trying to optimize returns, but also dedicated teams that are looking to shift towards the kind of, let's say, the more trend focused sectors, etc., that we see in the market.
Philip,
yes.
Sorry to interrupt, but perhaps could you turn off your videos? Your audio is cutting out occasionally. And so if you switch off your video, it might improve the sound quality.
Okay, I've done that.
Okay, sorry to interrupt.
No worries. No one needs to see me on a Friday morning. It's absolutely fine. So yeah, obviously let me know if that deteriorates any further. So just where we are in terms of allocation right now. You can just see sorry, just lost. David, can you hear me?
Yeah, you're all good.
I've just lost my screen though. Can you guys, or is it just me?
I can see the slides, yeah.
Can you control them? Sorry.
Yeah, sure, yeah.
Can you do that? Yeah, sorry, literally, it's just kind of, you can still see me, but I just lost them. But yeah, basically where we are is looking at where we are in terms of the different sectors. We have real estate, actually, as a slight overweight. We have infrastructure and transportation a little bit underweight as a result of the real estate overweight. And obviously, we have also a liquid real asset allocation, which kind of just gives us the opportunity for maybe some more tactical allocations over time. So let me just sort myself out a little bit because I can't see the slides. So 6. So if we can just move on to the next slide and just, David, just give me, we are now on the portfolio exposure slide. So we're looking at sectors now, yeah? Oh, we're on geography. Okay, so slide 8. So just wanted to also talk about where we are from a geographic perspective, because we are a global portfolio. And I think that's quite unique within the real asset market, because we have, I should tell you, a market which is still primarily domestically focused. You know, UK, maybe European real asset markets, and that's, you know, obviously, you know, seen some really strong returns and obviously delivered some pretty good outcomes for investors. However, you know, what we were hearing, particularly when we launched Jara, and we see this, I'd say, more of a case for this over time as well, is, you know, like other parts of people's portfolios, it should be global. And so really what Jara is a global portfolio, and as you see, 2% UK, really offering that kind of global complement to often domestic exposures. Now, I think the benefit of that has become more apparent even since when we launched. Because if you think about a lot of the return drivers of Jara or of the real asset market, it's often, how should we say, locally focused, whether it's the local demographics of a market, whether it's the regulatory regime, the political regime. These are often helping drive the return, but also the risk. And so often, you know, we do feel that actually one of the largest risks within real asset is that kind of local risk, and actually having it diversified across different countries does help, I'd say, create a more resilient outcome. So if you think about, for example, you know, for example, what we've seen this week, where you know, some in the ground renewables, given some of the announcements by the UK government. Not to say Jara is insulated from that or political risk in total, but it's diversified. And so we're not relying on any one local regime, local market dynamic in order to give us that return. And so we are, I think, a nice complement for people in that way. And you can also just see on this page, again, Jara's unique diversification on an asset level basis. You know, if you look at Jara's market cap, we're around, you know, 210, 220 million pounds. That's grown nicely since IPO. You know, we launched at 150, and so we've grown it by a nice amount, and obviously we'd like to continue to do that. But with a kind of 200 million vehicle, in many ways, in the core real asset market, it's quite difficult to get diversification. But actually, because we're using Jara's or JPMorgan's platform, existing platform, we have a really good look through asset diversification, over 700 infrastructure and transportation assets, over 200 real estate assets. And so again, not just a diversified country exposure, but on a look-through basis, different countries, different markets, different counterparties that should make the return over time more resilient. One thing to highlight with JAR as well is we are, as a global portfolio, we do have global currency exposure. And that's something which we try to make transparent to investors. You can see that at the bottom of this page, just over 60% allocation to assets that are dollar denominated, and then a good mix of other currencies. And obviously, currency can move around over time. Actually, that dollar exposure has been obviously, as people will be aware, a nice tailwind over the last couple of months. But ultimately, what we're looking to do is maximize and have see, as kind of a byproduct that should hopefully equal out over time. If we move on to the next slide, just talk about on a look-through basis portfolio exposure, and you can just see here. It's talked about the big sectors. You can just see here where we are across the different real asset markets on a look-through basis for the various sectors. And you can also see on the right-hand side some of the direction of travel. That direction of travel is driven by one, what we've done recently, but also two, where we see our pipelines. And maybe a couple of things to put out here. If you look at the real estate side, as I mentioned, we've got a broad overweight. We have had a broad overweight to real estate, given its strong outperformance. But in particular, where we've seen the opportunity is one, industrial and logistics, and two, residential. I don't talk about logistics, and a lot of managers have focused on that. I think more interestingly is what we're doing in residential. Globally, there is an undersupply across developed markets for homeowners. Adding investment into that is a really, really good return, but also diversifier for a real estate portfolio. We're doing it in two big ways. One, in Asia, where we have a real estate exposure, we are doubling down on Japanese multifamily residential. Japan is a unique market where you have the unique, let's say, scenario where you're getting high levels of household formation in the cities, because the millennial generation, or whatever generation comes after millennials, is moving out of their family home in record numbers, and therefore looking to rent out the 1-bed, 2-bed apartment. The area in residential we're targeting is US suburban housing. So again, a pandemic-driven trend here, where people are looking to move out the city, maybe because they only need to go into the office 1 or 2 days a week, or 2 or 3 days a week. And actually now 60% of our residential allocation within the US is suburban, really playing into that trend, seeing really, really high levels of demand, as people have probably seen in the news. Infrastructure, utilities and renewable energy are big overweights, and also where we see the growth coming from. We like this one because these are the most core parts of the real estate market. So these are the parts of the market with the largest, let's say, or the longer term contracts that are often inflation linked. But also, these are parts of the market where we see the most opportunity in terms of building out our infrastructure platform. We often do a, let's call it a kind of platform basis. So we have large scaled portfolios, let's say, for example, a solar farm portfolio that operates across Europe. And instead of buying other large trophy transactions, we're looking to grow the asset through smaller bolt-on acquisitions. And often you can do that in the best way through smaller transactions. And often that's better in fragmented markets like utilities and renewable energy. Transportation, maritime is our largest sector. Energy logistics is the one we're focused on, and I'll touch about that in the next couple of slides. I'm kind of cognizant that I'm getting close on time, just going to speed up a little bit. But on slide 10, so the renewables opportunity, these are, I just wanted to touch on, I'd say, two of the big areas of conviction that we see in infrastructure and transportation. And in many ways, these are both kind of driven by particularly around how does Europe really think about energy independence going forward. And in many ways, there's two approaches that you're seeing to come forward. Firstly, a double down, renewed focus on renewables. You can just see on the left-hand side of this slide the energy mix and the kind of forecasted change in that energy mix over time. This was cut at the end of 2020. It was a kind of analysis done by BP. If anything, that green line, the renewables line, has got steeper because countries, for example, Germany, are looking to accelerate their transition towards more renewables. That's great for both existing owners, but also for future opportunity. And we're glad to say that we are actually one of the largest owners of private renewables out there already. We have a gigawatts worth of renewable generating capacity. So this renewed focus is great for our existing assets. And obviously they're also benefiting at the moment from the higher energy prices that we're seeing. But also as an investor with a significant platform and a significant footprint, we are also in a good place to continue to grow that. And actually we have a pipeline that actually potentially sees that doubling over the next few years. Our main focus is onshore wind and solar, but we've also started to move into some newer technologies, things like biomass, and we'll expect that to grow over time as well. Next slide is on LNG, and you can just see here what another big area of conviction for us in the transportation market. So in transport, what we're looking to do is really own moving infrastructure. Moving infrastructure in the container ship market can be LNG carriers, can also be aviation. Aviation is the smallest part of what we're doing within transportation for obvious reasons. And really where we have the conviction going forward is what we kind of call energy logistics. So transportation assets that are going to help in the energy trade. Now, in particular, within that, LNG is an area of focus for us. We started to invest in LNG, so liquid natural gas carriers, in 2019. However, instead of buying second-hand assets, we wanted to take a new build approach. The reason we want to take a new build approach was because, as you can see on the top left, we felt there was a big benefit in getting into the newest, most fuel-efficient technology assets possible. Them types of assets are in the pie chart top left in terms of two-stroke or dual fuel assets. And effectively, these are assets that can, yes, burn maritime fuel, but also switch to LNG as a fuel as well. And that can actually make the LNG carrier up to 60% more fuel efficient than the same type of asset that is 10 to 15 years old. So instead of buying second-hand assets, we thought, okay, let's build out a portfolio of brand new assets that have the newest technology in them. These new build assets are now getting delivered. When you put an order on, it often takes a couple of years for these assets to be built. And we actually now have 14 LNG carriers either delivered already, and we have 2 delivered, so operating, and we have 12 more that are under construction and set to be delivered in the next 12 to 18 months. These are big assets, almost $200 million a piece. There, 14 assets is several billion in asset value, and really shows the benefit of us being able to tap into JPMorgan's broader platform in order to make our investments. Obviously, great timing in terms of the delivery. LNG is again a very, very likely fuel for particularly countries in Europe to think about energy security. How do they get LNG in order to reduce their kind of reliance on Russian oil and gas? And so again, great timing for these assets to be delivered. They're not all in the portfolio yet, but the nice thing is these are already under construction. If you were to put a new asset on today or to order a new asset today, you're talking about 2025 or 2026 before delivery. Last 2 slides very quickly. You can just see some of the sector themes JARA is allocated across. Hopefully I've touched on each way. Sector themes, energy transition, whether that's renewables, as I've talked about, or LNG, where we're seeing opportunities as well. The e-commerce acceleration, I talked about how industrial is now our largest allocation and will continue to be going forward. We also have a decent allocation to container ships, which are also benefiting from that trend. New core sectors, so that's all about, okay, as the world changes, how do we evolve our portfolio? And getting close to 10% of our portfolios in sectors which we wouldn't have defined as core 5 or 10 years ago. And then also, how do we have a positive social impact through our assets? With a portfolio like ours that is multi-billion on a look-through basis, we are fundamentally part of communities. That is a big responsibility that we are very much focused on. For example, we look after 5 million customers through our utility assets. And how do we maximize our social responsibility, make sure we're doing the right things? Finally, on slide 13, just quickly on our performance, you saw these high-level numbers on the first page. But what I would just say is, we've been going for 2.5 years. The first year was a ramp-up period, so I feel like the since inception numbers aren't necessarily reflective of the portfolio you're buying into now. Really focusing on the 1-year numbers in terms of the return. You can see here what we've achieved. North of 12% GBP return, local currency 9.9%. So really at the top end, if not beating our target return expectations over the last year. Given what we've seen, hopefully in the kind of operating environment going forward, we're hoping to achieve something similar. And so with that, I will pause. I know I went 35 minutes instead of 30, and obviously see if we've got any questions.
Great. Yeah, we do have some questions. Thanks very much for that. That was all very interesting. Perhaps to start with, we have a question from Andrea who asks, the trust, I think, is trading at the moment on a 7.3% premium. So she asks, are you anticipating raising further funds via placing this year? And if so, will you also facilitate small investors to participate? I would add to that, if you do end up raising money, is there anything that you are looking particularly at to invest in?
Yeah, sure. So first part of that question, we'd love to continue to grow Jara. We've done that since IPO, and we'd love to do that further. What I would say is that kind of 7 to 8% premium is on obviously the last NAV. We announce our NAV quarterly. What I'd highlight is NAV. So thinking about what that would be on a kind of more up-to-date currency basis, it's not quite as significant a premium as that.
Sorry, could you you just cut out a bit? Could you maybe say that again?
Yeah, so just to say that that's on our quarterly NAV. Our next NAV is out at the end of May, and that will include obviously updates to the portfolio, but also obviously kind of the renewed currency environment where dollar has strengthened. And so you may see that premium come down a little bit once we see a new NAV. But yeah, look, we would definitely look to grow. I think initially through, and if we stay at this kind of premium for a sustained period of time, which is obviously important as well, we would look to grow initially, I think maybe through tap issuance, as we have done so far. And then to the extent there is demand in excess of that, then placing is particularly given the opportunities we see. And also onto the second part, we are, our underlying teams operating across the real asset market are seeing significant opportunity. I would say that we've had this overweight to real estate over the last 6 to 9 months, and as potentially you start to see a slowing economy, I would probably expect to see that to be reweighted back towards a more balanced portfolio with infrastructure and transportation being slightly less economically sensitive asset classes. And so I expect that money to go primarily towards infrastructure and transportation. Again, into the big areas of conviction I highlighted, renewables, we've got a big pipeline there, and in transportation, energy logistic assets, particularly in financing and completing the build out of our LNG fleet.
Great. Okay. Well, we've also had quite a few questions on inflation. So maybe to start with, If the income is inflation linked, how long does that take for raising? How long does it take for rising rates to show up in your income stream, do you think?
Yeah. As I said, I think I highlighted this earlier. It does require a sustained level of inflation in order to kind of eventually pass through. I would say that the most explicit areas of inflation protection come in the form of our infrastructure assets. We typically see a beta there to inflation of between 0.7 and 0.8. And a lot of that comes through within a kind of a 6 to 12 month lag. So, for example, in utilities, not that we necessarily own UK utilities, but you talk about the kind of the price caps, etc. That's the country you're operating in. That's typically somewhere between 6 and 12 months. Similarly, within real estate, a lot of our contracts and tenants are on inflation kind of linked contracts and tenancies. And again, that's done annually. So I would say, depending on what part of the portfolio you're looking at a beta of between probably an inflation beta of somewhere between 0.6 and 0.8 across a lot of the assets. That is over the long term. And I would say it takes 6 to 12 months for that to kind of start feeding through.
Okay, let's move on to a different one, different topic. When could investors expect the dividend to grow and at what sort of pace?
Yeah, slightly difficult one for me to answer that, obviously, because just to kind of say, obviously, the board set a dividend, and is how they increase it. I mean, if you look at our income at the moment, we're currently paying out 1p per quarter. So that's annualized at kind of a 4.4% at 4.4% on when we cut the numbers last. And there is a bit of headroom to grow. And actually, in particular, as we reweight towards infrastructure and transportation, these are more income orientated asset classes. Real estate is a nice mix between kind of a kind of near 4% income, but also with some decent capital appreciation. Whereas in infrastructure and transportation, we're getting the significant majority of our return from income. And so actually, if and when we reweight towards the infrastructure and transportation side, the board will have more headroom. There has not been a necessarily a number put on it by the board, but obviously they're cognizant that we're now in a state mechanisms they do have board is to how do they increase that income over time, and hopefully it's my job to try and give them some headroom to do that.
Great. And maybe a bit more of a technical question. Chris asks, in the slide showing 60/40 plus 20 JARA, can you confirm that 20 all comes out of the 40 bonds, not the 60 equities?
It was pro rata, so it'd have been 2020. So yeah, you'd look better if you just did if you just took it out of bonds, I guess. But I think either way, you're looking at hopefully an improved portfolio outcome. What I would say is on that analysis, our long-term capital markets assumptions are beta numbers, i.e., no portfolio.
So you cut out a bit there. Maybe could you say it again?
It's all going badly, but yeah, these are the long-term capital markets assumptions are beta numbers, just so that they kind of try to capture broad market returns. And so actually, hopefully, if we can capture it both at the underlying asset level and obviously the asset allocation level, there's the ability to improve on that as well, because obviously looking to generate alpha. The 60/40, as I mentioned, if I cut out for that bit, was a pro rata rebalancing into JARA.
Okay, and we've had a couple of questions come in on raising new funds and avoiding cash drag. So if you do raise new funds, how do you avoid cash drag?
Yeah, sure. And for those maybe who have followed JARA, that was a soon after IPO, with obviously the pandemic, there was a bit of a cash drag, primarily because during the pandemic, it was, we were very, very cautious about how we made investments. So first thing to say is, our investment expectations in terms of timeline have shortened significantly from where we were, let's say, in mid 2020, when we did have a lot of cash in the vehicle. And so, firstly, if I was from a standing start, just looking to get £1 invested, we'd expect that to be quicker. We have, we're seeing investments, way within the kind of the 6-month period. On top of that, we are also looking how to optimize that as well. And so there are options available to us. So firstly, how do we think about using our liquid allocation to potentially price back of that? Similarly, thinking about how we potentially have a leverage facility. Again, you see a lot of funds do this in the market to invest in private assets and therefore reduce cash drag, and also thinking about utilizing the active management side of things more, and making sure we are being proactive about as and when we raise capital in order to get money in the ground in an efficient way. So firstly, I'd say the market environment has changed, and so we do expect to get money in the ground quicker, and also leveraging some of these other things like leverage facilities, our liquid portion should all help that, to make sure that when we do raise new capital, the cash drag is relatively minimal. I can't say it'll be zero, but obviously making sure it's absolutely minimal is a focus.
Great. And next question is maybe a bit different, but how do you establish that you're paying a fair and reasonable price for JARA shareholders when buying into JPMorgan's institutional private assets?
No, that's a great question, and actually we did a big session with the board recently, just on going with our various valuation partners we have, and ultimately we're investing in private strategies that are valued quarterly, and every quarter across the various asset classes we're investing in, we have an absolutely robust and independent valuation process, both within JPMorgan, where the valuation team sits totally independently from the investment teams, but also through the various third parties that we use as well. So in every quarter, you have involvement from third party valuation companies that are going, checking the assets, making sure that the and basically JARA then feeds into that. And that's both on the way in and on the way out, by the way. So the ability for JARA to invest at fair value and also redeem at fair value is absolutely there, with independent valuation processes done, with also audit reports, etc., that come out on an annual basis from PwC. So we've been running these portfolios since the oldest one is 1998, and so it's a very, very well established process in terms of valuation that's also stood the test of time through different market cycles, and so one that we feel very, very happy to kind of sit behind.
Okay, bit of a different tack, but do you have any geographic preferences within real estate or infrastructure?
Yeah, it's a question. So within real estate, what you're seeing is actually probably in terms of just kind of longer term returns, we don't have a European real estate allocation within JARA. That was part of our initial design, really, where investor feedback was we don't want a UK and European allocation because we already have that. However, if you look at long-term expected returns, the European real estate market for us does have lower expected returns than the US and Asia. After that, we definitely have a preference, on the most part, to the Asia real estate market. When we think about Asia real estate, we're talking about the developed markets in Asia, so Australia, Japan, Singapore, etc., etc. And basically what you're seeing is a bit of a lag the is versus the US. You know, in the US, if you look at what's happened with logistics, you've seen rental growth, you've seen cap rate compression, which ultimately, whilst we still expect good returns, can't be maintained at the levels they were last year. Asia's a couple of years behind, particularly in the logistics space, where we see a lot of opportunity. You know, we're still buying into logistic assets that in Asia, across Australia, Japan, Singapore, etc., that are offering us a 7% net levered yield, and so really good opportunities there. Primarily on the logistics side, where we're seeing the biggest pricing differential, but also say some opportunities in residential as well. Within infrastructure, it's depending on what sector we're talking about, we may have a different geographic view. On the utility side, and we do have a preference to the US. The US, I talked about regulatory or kind of local risk earlier. The US is a very fragmented market. Often these things are regulated state by state. And so that gives us nice diversification. Things aren't really done at a federal level. We see a lot of fragmentation in the utility market. There's thousands of operators in the US that can be consolidated over time. And so that's where we have been putting a lot of utility money. And the nice thing is, in order to get a let's say approval from a utility perspective to own utilities, ultimately being JPMorgan is very, very useful. On a renewable side, I would say generally Europe has been our happiest hunting ground and will continue to be. It's slightly ahead of the US, as everyone knows, and we still see a lot of opportunity there as well. So in infrastructure, it's US for utilities, not Europe.
Okay. One more question on asset allocation. So who makes the big asset allocation decisions? Is it yourself or the board or someone else, perhaps?
Yeah. So I didn't necessarily have a slide on this earlier, but basically it's myself and my team. I'm part of the investment committee that manages JARA, and I sit as part of what is effectively the alternative solutions group here at JPMorgan. And our role, we've been going for 10 years or so, and effectively we're kind of a multi-asset team in the private markets. We have various portfolios, of obviously which JARA is one, and the investment committee obviously reviews and considers asset allocation decisions on an ongoing basis, both with our existing capital, but also when we invest, how do we deploy it in an efficient way. I am the kind of, let's call it the European-based investment member of that team, and my broader team, managed by Jamie Kramer, head of the Alternative Solutions Group, are US based, and it's a committee decision. The board are obviously there to review and look at kind of particularly the risk aspects of the company, but ultimately it's our decision, and obviously the board are there to check us and make sure we're operating within the remits we've agreed with investors.
Okay, and we've had, perhaps to finish off, we've had a couple of questions on JARA's return relative to the platform return. Could you talk about that a bit?
Sorry, what do you mean by relative to the platform return?
Question is, has JARA's return ever exceeded the platform return? I assume they're talking about the returns from, maybe you can clarify the question, Krishna. I assume he's talking about the investment universe that you.
The investment universe, yeah. I mean, obviously, all I'd say is with JARA, obviously, we're still looking at a relatively short history in terms of we've been going just over 2 years, and one of that was during COVID and during ramp up. But if you look at our return last year, we exceeded a lot of allocations that would have been sector specific. So if we'd have just been invested in infrastructure or just been invested in transportation, we did outperform that. And ultimately, the underlying platforms we're leveraging, and so I don't necessarily think we can necessarily exceed it. What we're looking to do is get the resilient return by allocating across different parts of the market, in order to kind of make sure that that's as resilient and as consistent as possible. hopefully we continue to do that. And we obviously once we have a longer track record, hopefully we can show that we've been doing that on a consistent basis. But I'd still say relatively short period for kind of that kind of comment to be made.
Great. Well, thanks very much for taking all those. Quite a lot there, so I'm sure that was much appreciated. And thanks everyone else for joining us. If you missed any of the other webinars earlier in the week, those will be going up on the KTO website, so look out for that. And yeah, thanks very much, Philip. That was fantastic.
Brilliant, thank you, and apologies for my dodgy sound, but thank you everyone for joining.
Thanks.